bank is manipulating the markets that you are trading. So what actually is a central bank? The central bank of an economy is in charge of money flow, money supply in the market. Its role is to ensure economic and price stability. So it's there to essentially just make sure the economy is stable and sound. If the economy isn't, and we're going through an economic downturn, which we go through these economic cycles where growth is low, we're potentially contracting, unemployment is high, inflation may be high as well, and growth may be low, which is known as stagflation, or we could just have low inflation and low growth, so on and so forth. Now, a central bank will then need to analyze everything and make a decision. How can we prop up the economy again? It's not looking good. How do we prop it up? Well, we can take action. We can first of all look at lowering interest rates. Because remember, we're lowering borrowing costs for people. Think of it as this. You're a consumer, right? You may have a mortgage, you may have credit card balances, you may have loan balances. When the central bank is taking action and cutting interest rates, as you may have heard the terminology, they're lowering your costs for you. Essentially, you have a few more coins and cash in your pockets to then go and spend and try and prop it up and stimulate the economy. That's the sort of action the central bank will take in terms of interest rates. They'll also look at introducing what's known as quantitative easing, stimulus. Effectively, we're printing money. They're pumping money out to the markets. They may give out operations to banks because during times of economic downturn, banks will be reluctant to spend money. They want to try and keep as much cash as they can on reserves. Central banks will offer these lending facilities where they say to banks, look, you can take this money, it's free money, cheap money, lend it out to consumers. Lend, spend, and stimulate the economy. You see how that works, right? If we're going through a period of an economic boom, okay, the economy is booming, it's heating up, decent growth, there's a lot of people in work, wages are high, unemployment's low, and inflation's now starting to rise. And as the economy's heating up, inflation's rising too much, getting high. Now, a central bank must think, if we've gone through this economic downturn, okay, where they've had low rates, pump money into the markets, they now need to tighten up. So then what they'll look to do is initially start to reduce some of that stimulus from the markets. And then what they can look to do is start to what's known as lift off, lifting rates up again, raising rates, okay? Because remember, when we raise interest rates, we start to cool the economy down. We start to cool people down, slow people down from all this spending that they're doing, making prices of goods and services rising, causing all this massive economic growth. So they slow things down a little bit. So you can see what they do in different economic cycles, and you can profit from this because when we're cutting rates, the value of a respective currency goes down. It goes down initially because remember, from a foreign investor's perspective, foreign investors are looking where they can invest their money in economies that are paying high interest rates. So if a central bank is lowering rates, it's turning off potential foreign investors. So the value, the demand for that currency comes down. And obviously the flip side, if they're raising rates, that's going to attract foreign investors because foreign investors want to come and invest in economies and central banks that are paying higher rates of return. That's with currencies. And then we have the example of with indices, right? During periods of hiking rates, it's going to hurt indices because costs are going up for them. And, if we're cutting rates, this is great for stocks. Stocks love it in low interest rate environments. Stocks love it when the central bank's pumping money into the economy because people get all this cash. They've got all this cash, all these stimulus checks, all this cash. And they go and spend. And then the value of that stock and the indice goes up because people are spending, buying these goods, using these services in these businesses. So you can see how much of an impact and an important role the central bank plays in influencing the assets that you're trading.